That's massive. It's huge. So that means that there are other players on the other side of that that would benefit from it. But when you have that kind of volume on a system that is rehypothecating and trading contracts, where, for example,
They want you to think gold is dead, that silver has lost its shine. But Andy Schectman isn't buying that lie. While the mainstream screams sell-off behind the scenes, the biggest money on earth is quietly loading up on real metal. Paper contracts are crushing prices. Media headlines are steering the crowd. But the question is, how long can manipulation keep the truth buried? Because when this dam finally breaks, those holding paper will have promises, and those holding gold and silver will have freedom. So is this a dip to fear? Or the last chance before the breakout of a lifetime? Let's find out what Andy Schectman has to say.
Michael Lynch says Barclays sold 1,969 contracts, RBC customers 1,076, and Scotia House account 2,024. And, could it be profit taking from earlier buys? Maybe. But at 100 ounces apiece, when you're talking 2, 3, 5,000, 6,000 contracts, that's an awful lot of gold being dumped. We don't know who and why they would do it specifically, but he is saying it's the banks that are not the U.S. banks. Barclays, RBC, and Scotia are the ones that he points to, and he has all sorts of empirical data.
He has the evidence.
Yeah, you can go. You can go and take a look at his Substack. He publishes what he believes is the data and the footprints, the fingerprints to who sold. And I don't think it's just them. But again, it's like pushing a rock down a hill. And once it starts to move, it starts to, like a rolling stone, it starts, or a snowball starts to get bigger and bigger and bigger. It's getting bigger because it's triggering stops along the way. There were a lot of people that sold into this rally who would have probably hoped never, into this drubbing, that probably hoped they never would have had to have those stops triggered. But I think that's what happened in the middle of the night, when you saw such a massive drop at a period of time when there was no liquidity, which just dropped the price. And then all of the triggers that would then automatically hit to sell to protect these funds from getting killed would only add to the drop. And then you had the value buyers come in and push it right back up. That's too coordinated to be coincidental. And I mean, yes and no. I mean, I don't think it's realistic to expect it to go straight up.
Sure.
But I think that from a standpoint of where it is ultimately going, I think it's going to continue to go higher. The bull wants to take as few people along for the ride as possible, Michelle. That I do believe. And so, I think that ultimately the markets will have their way. But again, you have a lot of very big players who are on the wrong side of this, massively short. Bob Coleman was talking the other day of the managed money being short 1 billion ounces of silver, in essence. And, that's massive. It's huge. So that means that there are other players on the other side of that that would benefit from it. But, when you have that kind of volume on a system that is rehypothecating and trading contracts, where, for example, you look at David Jensen, who's going to come on our show. He talks about 140 million ounce float in London that's trading 600 million ounces a day in deliverable contracts, with as much as 2 billion ounces in contracts out there that could stand for delivery with only 140 million ounce float. Now, what could possibly go wrong? What could possibly go wrong? And maybe that's why Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates because of that. Because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Luongo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it, but all I can simply tell you is that, to me, the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory, tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates, to make good on short contracts that were getting very close to, creating this huge squeeze that everyone has been waiting for forever. Could it be that? Yeah, why not? Sure, there is some legitimacy to profit taking, to look, it's gone up too far too fast, and technicals say you should take profit. Some of that is true, and I believe that to be true. But that's cover for a bigger story as far as I'm concerned, and I think that's really what I take away from all of this.
I
There
mean,
are
that,
no free markets anymore, Michelle, just manipulations. But you can see the movement of these assets, these commodities, largely moving to the global south and east. And the exchanges that are popping up in places like Singapore, Shanghai, Dubai, Moscow, St. Petersburg, the BRICS facility that they're building, these will be the price setting mechanisms that will take over for the LBMA and the COMEX. Maybe not the COMEX if President Trump has something in store. Hopefully he does. But I would argue that the Western system of pricing commodities is coming to an end. And certainly those that are rehypothecated the way that they are, you look at those exchanges across the globe, they're largely cash and carry, pay, receive. The ability and I'll bring you back to 2020 in the middle of the pandemic. Oil went to negative 40 a barrel. Now, how the hell does that happen? How does oil go to negative 40 a barrel? We'll pay you to take the oil. Well, the point of it is that when the futures market is the tail wagging the dog, setting the price for the underlying commodity, you have a problem. It should be the commodity that sets the price for the futures, not the other way around. And I think the world is growing tired of the way that the West has been able to control the commodity complex for all of these years. A lot of that's true. A lot of that's fair. Look, we blew through 2000, never challenged it. Blew through 3000, never challenged it. Blew through 4000, still haven't challenged it. We may, but as we said, support a step back in. But when you follow the narrative, the conventional wisdom of the mainstream, and some of what they say is legit, based upon what I just said, and blowing through these averages, 50, 70, $100 a day moves, that's unprecedented to the upside. But when we look at what happened in the middle of the evening last night, where in the thinnest part of the trading cycle, when New York is fast asleep, someone or some entity or a coordinated effort dumped a massive wave of futures contract onto the market. Again, when New York was fast asleep, this drove silver under $50. It knocked gold down $100. But then something interesting happened. I mean, this was shock and awe, Michelle. This is a drive-by shooting, right? Any trader that would be stupid enough to dump that level of futures onto the market at the thinnest trading segment of the day, when there's virtually no liquidity, would be fired and shot, and probably not in that order. And it was specifically done for effect. But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes. But someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. The interesting part about that is it was a month ago where the chief investment officer for Morgan Stanley came out and said, yeah, the 60-40 mantra we've been talking about for so long, we think we should sell 20% of the bonds, 60-40 being the Wall Street steadfast way of investing, 60% stock, 40% bond. He says, no, let's do 60-20-20, 20% bond, 20% gold. Well, Michael believes that there are footprints of Morgan Stanley and Bank of America, whose high price analyst, Michael Hartnett, whose newsletter I believe is at least $10,000 a year, only speaking to the institutional traders, came out and said, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. Bank of America last week raised their target on silver to over $66 or $67 for next year, with an interim price, medium price between now and then, or an average price of somewhere around 57. He goes on to talk about that since October 17th, 6,000 new immediate delivery contracts were written, which is all but a record for this late stage of the delivery cycle. And he goes on to say, if the pace continues, it could be one of the biggest delivery months ever on record, challenging the February and March deliveries. So in other words, the market got bombed by paper in the middle of the night when no one is trading and New York is asleep, which provides all the liquidity. But yet someone came in and gobbled a whole bunch up. And at the same time, we saw 11,000 paper long contracts closed out. So this is a very unusual drive-by shooting for effect type of sell-off, yet some of the fundamentals that are cited by the mainstream are true. It's a half-truth. Yeah, those things are true, and the markets can stay overbought for a long period of time. But to ignore how the sell-off occurred and just simply say this is profit-taking is ridiculous.
Andy Schectman just revealed what few dare to say, that gold's fall isn't the end, it's the setup. While the charts may look weak, the fundamentals are boiling beneath the surface. The paper game can only delay reality. It can't erase it. Because when truth finally breaks through manipulation, those who prepared will be the ones standing on real wealth. If this insight opened your eyes, hit like, subscribe, and tap that bell icon. Because every week we expose the real story the mainstream won't tell you. Right here,